Hey folks, hope you're all well and welcome back to the Market Structure Education series. The last video was a little longer than expected, and I decided after I watched it back that I adequately covered the subject matter I had planned for volume 2 and 3, so this will be volume 4 in the series, covering multi-time frame trading ranges and order flow. If you haven't watched the first 2 videos in the series, I'll link them on the screen somewhere or in the description, and I'd recommend going back to watch those first before jumping into this, as we'll build on what we covered there. This will hopefully make sense as a standalone video, but the principles described in there frame the subject matter for today. To reiterate, this is very much just the way that I view and utilise market structure. There are other ways, quite possibly better ways, but this works for me and that's all that I present this as. And in today's video, you'll see more items you might recognise as ICT teachings if you're into ICT, or certainly my interpretation of those. I'm not trying to teach ICT theory specifically. If you want to have a look at that, I'll link his channel in the description and in my channels list as well, so you can check that out. There's a huge amount of great content on there. These sessions will just cover my implementation of some of those strategies. And I should confirm, I'm not talking about ICT's market structure here. This is very much my view on market structure, which differs a little. It's more the point of interest and areas of interest within the structure that is ICT specific. So this is a combination I find that works well for me. So goals for today, building on the previous 2 videos, will be understanding major trading ranges and how to identify active range on a single time frame, understanding the major trading ranges and how to identify the active range on multiple time frames, understanding the relationships between each range from a fractal perspective, identifying point of interest within each trading range where we might expect price to react, understand the relationships between the point of interest and the ranges working up and down through the time frames, order flow within each of those trading ranges and within each of those time frames and how that order flow relates to the time frame up and down, and understanding how all of these relationships combine to provide clues on where price might be headed in future. To recap a little, let's have a look again at a single time frame structural schematic. So the major highs and lows are identified here, as well as order flow in this time frame. I'm not going to go into this in too much detail, it's just on the screen to refresh your memory as to what this looks like. And similarly, on this slide as a refresher of how that looks when time frame -1 is added, and we see the lower time frame major structure inside the higher time frame structure. Of note here is how each leg of the higher time frame structure, in terms of the impulse and the retracement, contains a full higher time frame structure start to finish within that lower time frame. This is the fractal nature of price and a key point to understand for this sort of analysis. And to hammer this home a little, let's quickly look at this example from a chart. It's Dixie to keep it consistent with what we've been looking at so far, and the time frame here is daily. So notice how inside the daily structure exists the H4 structure, which I've mapped out here. And that H4 structure is a full fractal of the overall impulse and retracement schematic. Charts are never really as perfect or as clean as this schematic looks, so it helps to practice this and get comfortable mapping out on your chart so you can understand the different ways that this flows through. And I would encourage doing that. Like, go to your charts, map this down through the time frames and get an idea as to how this all hangs together. But if we look at the general movement here, we can see that fractal. And if I concentrate on this middle section and note how the impulse reached a high, then H4 structure shifted back into retracement before continuing. And that H4 structure looks like the full schematic from the time frame above. And that's the point I'm trying to make here. This is how the fractals look in price action. So with that, the recap covered, let's jump straight into the charts and have a look at this so we can have a look at how it works in a live example and talk it all through. We'll start then looking back at the goals on a single time frame trading range and how to identify that. So it's fairly straightforward. This is Dixie again, and this is the daily chart on Dixie. It's the one we've been using for quite a while. So if I drop the daily structure on that we've already mapped out and looked at a few times, we can see here the highs and the lows, and these are the major swing highs and the major swing low points. Now on this time frame, the trading range on this time frame is as simple as the points between the last major high and major low in the direction of the order flow. So as we can see here, order flow is bullish. This is very much high, higher low, higher high, higher low, higher high, higher low. So we're bullish order flow here, which makes this high here and this low here the demarcation of the daily trading range. So if I throw the fib tool on that, which is this one, you can see this is the current daily trading range. And in terms of this, this is just a standard fib tool that I'm using with 2 items in it, one for 0.5 and one for 1. with the background colours there. If you want to replicate that, that's the settings there. But it's as simple as just throwing that on, and that gives us our trading range. Now within this trading range, the reason I've got these areas highlighted in different colours is the 0.5 here is equilibrium of that trading range, and we would generally always look for price, regardless of the direction the order flows in, to head back to equilibrium at least after an impulsive move. So correct or retrace back to at least equilibrium is what we're looking for. It doesn't always happen, but in order to track potential trades and where it might be going, that's what we're looking for. And anything that falls above equilibrium is considered to be premium pricing, and anything that falls below equilibrium is discount pricing. So this is very much part of the ICT theory that I mentioned earlier, so I'm not claiming this for my own. This is something that I learned from him. And the general premise of it is, if you're going to be looking for shorts, you don't want to be shorting from a discount, you want to be shorting from a premium. And if you're looking for longs, you don't want to be going long from a premium, you want to be going long from a discount. So it's very much just gives us an area where to look for setups, and it then gives us a decent area to take risk off in terms of the extremes of those ranges. So that's a single time frame trading range and how you set it up. Once you've got your structures in there and you identify your major high and your major low, the range is the area between that, and that range is then split into premium and discount based on the 0.5 Fibonacci of that range. Nice and simple. So the next thing we're going to look at then is trading ranges on multi-time frames, how to identify them through the time frames and how they interact with each other. So this is the daily time frame, this is the one we've just been looking at. My next protocol would be one time frame lower, so I'll work up time frames and down time frames, and my lower time frame from the daily is the H4. Others will use different time frames. There's H12, H8, H6 are popular time frames, but for my own tastes, I use the H4, and that's something you'll need to play around with and see what works for you. So in terms of my next step, it would be dropping down to the H4, and we can see the daily trading range there, so I'll just make that a little bit bigger so we can see the movement within it. And then I'll map out the H4 structure here so you can see where we are inside that trading range. So this here is the low that created this trading range. So you can see in this example, it's a good example actually of the fractal nature of price we spoke about earlier. So the H4 is bullish as the daily sets its major high here, it's bullish as well. H4 breaks structure here and flips bearish and starts to pull back, and that signifies that the daily is taking its retracement. And if you look at this in terms of the highs and lows, you'll be able to spot that straight away based on the videos we've done so far, that this is a full fractal of that structure that I keep putting up in that schematic within the H4 inside of the H1 larger fractal. Anyway, it then breaks bullish again and starts to move forward as the daily is impulsing. Daily sets its new high, and then here H4 breaks its structure to the downside, which confirms for us that the daily high is set for now and the daily is retracing, and we'll see there that the daily has retraced into discount as we mentioned. We had this one little impulse up here where the H4 broke its high, but then it returns straight away on its next leg to bearish. So overall this H4 is still in bearish posture, which still signifies a retrace on the daily. So looking at the H4 range then, if we look at the current H4 range, it's the same premise as before, so previous high to previous low in the previous impulse. So it's this high here and this low here. Now this high wasn't broken by this high, we mentioned this in a previous video. It only whipped through it and it's candle closure that we're looking for, but as soon as this low was then taken by this candle closure, we're looking for the highest point at which that impulse started. So this becomes a major high from there because it was a higher point than here. So this is the highest point that broke this low, making this the H4 major range or trading range. So that is how it looks inside of the daily trading range. You've got the daily trading range as the larger range. The daily is taking a retracement, so we're looking for areas of interest within the green area on the larger trading range here for where the daily might stop its retracement, and within those areas of interest we're looking for the H4, which is a time frame down, and where does its structure break, potentially signifying that daily retrace is over and the daily major high will be taken, because remember we assume continuation until we see reversal. So when a trend is strong like it is on the daily chart on Dixie, we assume continuation until we see the daily chart break structure to the downside, and that would mean the daily chart closing a daily candle below this major low. So until a daily chart closes a candle below this major low, our assumption is that the daily is going to continue. What we're looking for within the H4 chart is where within this area could the daily retrace to before reversing, or if it keeps going further on the H4, will it then break the low? So that's the trading ranges inside, and you can see the H4 trading range has its own premium and discount levels, and they overlap slightly. And as you drop down through the timescales, if we were to look at H1 for example, I'll throw it on just without looking at H1, but the H1 trading range is there. So again, you can see within the H4 that's where the H1 is, and it's in premium of H4. So what I would have been looking for there is where is it going to turn the other way to signify that the H4 retraces over and the H4 is going to continue, because H4 is bearish. But we'll just look at the two trading ranges for now, the daily and the H4, and that's very much how they look and how you frame your ranges down through the time frames. I will actually, since we're looking at this, I will drop into the H1 and just show you how this works there, because I think it might give a better idea as to how this all hangs together. So here's your H1 structure. So remember, this is the H4 range here. This was the H4 low that was broken, this is the H4 high. So this is your H4 range. H4 is bearish. You can see here the H1 is bearish in confluence with the H4. H1 breaks here to the upside, signifying that the H4 has found at least a local bottom for now, and it's going to start retracing its bearish impulse. It starts to retrace that bearish impulse up towards the discount, the premium area of the H4 range, which is this larger range, and then we see here within that range the H1 then breaks. So this to me reads as this H4 retrace is complete. It's an area that we would expect to see reaction from. We'll cover that a bit later. This H1 low has broken, making this the new H1 range. So the one I've got marked has been broken. This is the new H1 range. So we would be looking for a retrace. I'll mark it out for you so you can see where we're at. So that's the new H1 range. We'd be looking for a retrace into the H1 premium before continuation of the H1 range, or the H1 price, heading for this H4 low. That's our assumption now. H1's broken bearish against the H4, so H4 is going to continue, and H4 is bearish, so it'll continue down, so we expect the low to fall. And if you look at these range breaks here, it's a very similar scenario. So breaks the range, retraces in below 50%, breaks the range, retraces in below 50%, breaks the range, retraces in. Now this one wicks below the range. This was a news based item. This was on the FOMC during the week, so we ignore that one for now. Again, breaks the range, pulls back in, breaks the range. This is a reversal because the range breaks. So that's how we look down the structures from top to bottom in terms of the multi-time frame ranges, and where we can utilise range breaks in the lower time frame to confirm our bias on where we think that time frame or the time frame above price is heading. It sounds a lot more complicated than it is. Hopefully it makes sense given the videos so far, but it's back to that previous, if the daily is bullish and the H4 breaks against it, then that's a daily retracement. So we're looking for where the H4 would turn within the daily range to signify the retracement is over. Same between H4 and H1. H4 is currently bearish. H1 is broken bullish, so it's against the H4. So this leg here is against the parent order flow. It's against the H4 order flow, which is bearish. So we're looking for where is this H1 going to turn within the H4's premium trading range to signify that the H4 retracement is done and it's going to continue lower. And we assume that H1 reversal is going to happen somewhere in here until an H4 candle breaks the H4 high, at which point the H4 has broken bullish again in confluence with the daily, and then we go back up to H4 and start looking for the daily range high and continuation of the daily range. So it's just work down, work up until you identify the most likely direction for price from that. So that covers our single time frame and multi-time frame trading ranges, and also the relationships between each of those ranges. The next thing we're going to have a look at is points of interest within those trading ranges that we'd be looking for reactions to occur from. So I'm going to jump back up to the daily on this one. We won't dive too deep into the trading ranges on this. We'll just look at one time frame down from the daily, which is the H4, just to give a quick example of it. So back to the daily chart and the daily trading range here. We can see the daily structure. We're looking inside the discount area for any areas of interest within there. So we can see here there's an area of interest at the bottom of this daily range in the form of a fair value gap. So that gap between the top of this candle and the bottom of this candle, where price was one way, that's deemed a fair value gap. And again, this is ICT theory, so I'm not going to dive deeply into how you identify these and what they are. You can look to source for that, would be my recommendation, which is ICT. But just know these are the areas that I use in terms of points of interest. There was another daily point of interest here, again another little fair value gap. I can expand that out to make it obvious. And we had this trading range here, which is close enough to the top of that gap that I'm not gonna mark it out. But previous trading range highs and lows are always good things to look for. So this trading range would have been somewhere I'd have been looking at. This trading range high would have been somewhere that I would have been looking at as well. So those are the points of interest on the daily. We've also got the daily optimal trading range, again another ICT concept, but it's basically the 61.8 to the 78.6 retracement zone within the range. So we can see here this daily fair value gap falls within that. So to me, that would be a reasonable place to be looking for a price to go. When I look at this in terms of the structure of it, this is a pretty common setup for an impulse, and that is clearly an impulsive move. You can see it's left 1, 2, 3 gaps on the way up, and this structure where it's up and down is very much looks like a corrective move. So it supports the theory that daily's bullish, setting up for continuation. It's just looking for its retrace area. If it continues to fall in the same way as this candle has, then that would be the next area that I would be looking for. And that, in terms of corrective structures, if you look at Elliott and wedge theory, I mean, this is not a wedge, but you would have your A, B, C, D, E, and then continue on. So I would be looking in that fair value gap there as a next point of interest, should the H4 continue in the direction that we think it's going to continue in, which is down. So if we drop to H4 then and have a look and see what price has done around these areas, we can see this first area was a reasonable place to be looking for this bounce. The next bounce came at the median point, 705 or around the 705 of the OTR before it's bounced here, and the final bounce may well see us in here if it continues in that direction. So that's the daily looking at the H4. So these are the areas that I'll be looking at in terms of points of interest within the H4, or within the daily. Sorry, for an H4 change back in confluence with it. So at this point, I was looking for a breaker structure to the upside to signify continuation. Now we got that in terms of, I want to put the H4 range on. This was the H4 structure. So we got that breaker structure here. And at this point in time, I was looking for longs because my assumption was trend is continuing and we're heading that way. Obviously, it didn't work out that way, so there would have been some losing trades in here, but that's going to happen. You're going to get losing trades at times. You can't possibly win them all. This is just a way to try and keep us on the right side as often as possible. As soon as this then breaks bearish again, you're then looking at H4 trades downwards, because I always look in the direction of the trend. And the H1 here, as we covered, is bullish at this point, so you were looking for H1 bullish trades within there. So we've looked now at the points of interest in terms of those are the kind of most common ones. There are others that we'll look at in a sec. There are the order blocks, the breaker block, range high, range low, previous range high, previous range low, fair value gaps, you've got volume imbalances, you've got CME gaps or price gaps on a normal chart outside the 24-hour markets. These are all areas of interest that we would look to price to go back to fill. I'm not going to cover why that's the case. As I say, that's for a longer lesson. This is just really looking at the structure. So let's have a look at the opposite of that. So let's look at the H4 and the H1 relationship here, just to look at see what the points of interest are on that. So I'll drop the H1 structure on again so we can see that. So H4 range at this point is here. So I'll mark that out just so we can see it nice and easy. That is the H4 range that we're concentrated on at this point in time. We're looking for retracement inside of that, and I'll put the trading range and OTR on. So straight away we can see that price here has come again back to what would be that OTR. There was also this previous major high on H1 that you'd be looking at. Nothing else really on H4 to this point. What we did have though was, if I can find there we go, was this candle here, which is a bearish order block on the H4. So I'll jump back up to the H4 so you can see this. So this candle here, where the H4 overall is bearish, so the order flow supports this. It's bearish order flow. This candle is the last up candle before a big down move. It's closed. It creates a fair value gap here. So this candle, there are different ways to use them. Textbook ICT is body to body, which, as you can see, would have been an accurate target here. It pretty much nailed that straight on. From all my testing, I get more success from wick to top of body or bottom of body, depending on the direction. That's just from my testing. It means I don't get potentially optimal entries, but it means I get more entries than I would otherwise that end up being successful trades. So I know it's not textbook for any ICT fans, it's just the way that I use it. But anyway, that's a bearish order block. And I would then look for the 50% level of that order block, which in this scenario it does happen to line up quite well with the body. But it gave me an area of interest in here, and you can see price hit that 50% level fairly well before the H1 then broke structure and moved down. So in terms of how you look at the points of interest and what you're looking for, that's what we're looking for. We're looking for where are the various different points of interest within this. This was the first one that I had marked out on H4, which is the fair value gap. It was, as you can see, straddling the equilibrium line, so there was only a small portion of it above equilibrium. We did see a couple of reactions from it, and this one here, but as soon as it goes beyond it, we then discount that. It's marked in there to show you that you're always looking for whichever one is closest to price at any given time, but you're not just then, or certainly I'm not then just entering that blindly based on the H4. I'm looking at the H1 to see if I see the reaction that I want from within that. So here we see the H4 bearish order block. It's already broken the H1 low, so this does to me confirm that we're looking at H4 major low again. I also wasn't looking at this on the hourly time frame. I was looking at this on the 15-minute time frame. So if I mark out the 15-minute structure for you, you can see this starts to make a bit more sense, hopefully. So I'm looking at H1 for where it will reverse within the H4 range. So I'm looking for H4 points of interest because it's an H4 reversal that I'm looking for. What I'm looking for is the H1 break-in structure within that range, and the H1 break structure within that range or the H1 structure break within that range will always be led by the 15-minute structure, because the relationships are the same between the H1 and the M15 as they are between the H4 and the H1. So we can see here H1 is bullish, M15 is bullish. It starts to head towards this. The M15 gets in here, major low, posts this high, breaks its structure, failure swing, breaks its structure again, failure swing, breaks its structure again. This wick here was the unemployment or the non-farm payroll news on Friday, and then the unemployment numbers came after it in the US. But we can see that the structure was already well set by that point we had seen the point of interest on H4, we had seen the H1 looking as if it was going to turn within that point of interest. The M15 had confirmed that that was the most likely thing was going to happen, so the M15 then led the H1 breaking its major structure. So that's working from daily to H4 to H1 to M15 to identify areas for potential trades and areas for potential direction within the structures. And as I say, the news this week was all high impact news, but as is often the case with high impact news, when you look at the structures like this, very rarely does it ever break the structure. You see volatility around the news and it'll wick through structures, or it'll temporarily reverse structures, but it generally always tends to return to the structure that it was in prior to the news. So that's the points of interest within each trading range and the relationships between those points of interest. Hopefully it makes sense. Go and try it, test it out within your own charts. If you've any questions on it, or you want me to do any other videos to clear this up, then feel free to put in the comments and I'll try and put something together. But that's us on the points of interest and relationships. Just a couple of more things to cover, and that'll be this video. Okay, last little bit before we wrap this up is looking at order flow within each trading range and the relationship of that order flow. So order flow is something that I've mentioned quite a lot during this. This is, again, the way that I use it. It might not be textbook, it might not be the way that it was intended, but it's the way that I find it works for me within this structure of using these structures, if that makes sense. So back on the daily again, and if I put on the daily order flow, the daily order flow here is quite clearly bullish. You can see the daily major structures, higher highs, higher lows, so it's bullish order flow. Now the thing that it takes a while to get used to is when you're looking at structure in the way that we're describing here, in terms of how the H4 structure reacts inside of the daily structure, and how the H1 structure reacts inside of the H4 structure, and how M15 reacts inside of H1, and so on and so forth, and even up through the daily, and how the daily reacts inside the weekly, and how the weekly reacts inside the monthly, as well as all of those time frames having their own trading range and having their own major swing highs and swing low points and major structure. They'll all also have their own order flow, and that's something that I think it takes people a while to get their head around. Sometimes that order flow will be in confluence, so sometimes the H4 order flow will be the same as the daily order flow, for example, but other times they'll be at odds with each other, they'll be inversely correlated, and that signifies the difference in terms of whether it's currently an impulsive move to me, or whether it's a retracement within that higher time frame. So for example, if the daily is bullish order flow like this, and I've mentioned this a few times, if the daily is bullish order flow like this and the H4 is bullish order flow as well, that signifies that the retracement is likely over. They're both in confluence, and the daily major high is likely to fall, because the higher time frame range extremes take precedent, or the higher time frame takes precedent, so we would expect continuation on the daily, because the daily is in confluence with its lower time frame. If the H4 order flow is bearish and the daily order flow is bullish, that to me I read as a retrace on the daily time frame that's been led by the H4. So the H4 is essentially retracing the daily there. That's why the order flow is different. And where that trips people up is within this scenario, and using the structure and entry points and points of interest this way, you would be looking for longs on the daily, because that's the trend on the daily. We trade with the trend, we trade with the order flow. But it's also legitimate then to be looking for shorts on the H4, because the H4 order flow is bearish. We know it's retracing the daily, we know the areas of interest that we're looking for that to reverse, so we can essentially counter trend the daily, but be on trend on the 4 hour, trading the order flow in the time frame that we're on. So the direction of your trade should always be in the or in my opinion should always be in the direction of the order flow on the time frame in which you're entering, but it should be led by the time frame above. So it helps you to define where your exit points are going to be. If you're taking a trade on the H4 and you know it's a daily retrace, you're not going to target the daily low, or you shouldn't be targeting the daily low, because the daily is bullish. Our expectation is that the daily is going to continue to the upside. So you would be targeting points within discount of the daily range, points of interest within discount to the daily range, internal range liquidity, in order to get out of your H4 trades. If the H4 flips in confluence with the daily, you can potentially then start looking at the external range liquidity in terms of the daily range high, because it's fair game to assume that's going to continue, and you may go higher. I wouldn't recommend aiming for your entire trade there. I would still be taking partials within the range, so taking partials at H4 range highs and H4 points of interest. But it's safer in that scenario to leave a bit more on for the daily range high, because that's the direction of the higher time frame trend. So to try and make that make a bit more sense in the H4, I'll stick this on. Wherever that has gone, there we go. So here we see that very scenario. So daily is bullish, H4 is bearish. So in this area we would be looking for shorts, and actually just now we've just described we're looking for shorts on the H4, and we're targeting that daily range. If we look at the H1, let's see another couple of examples of that, where within this area here, the H1 order flow flips from bearish to bullish inside of the H4. So this H4 range here, or order flow here, was in confluence with the H1. So you could have been taking trades on the H1 targeting H1 range lows, but also leaving a bit for the H4 range low, which was, I'll stick it on you, see it was here. So the H4 range low was here, it was bearish at this point. You could have been targeting this from any of these areas up here. As soon as the H1 flips bullish again, you're not looking for the H4 high at that point in time, the H4 major high, because we assume this is a retracement because the H4 is in bearish posture. So we're looking for the internal range liquidity, the order block we looked at before, for potential end points for your H1 trade that you've taken down here. H1 is going to flip again bearish here, where it has flipped bearish here in confluence with the H4. So again, you could be looking for a retrace back up into this H1 range, first partial at this H1 range. There's a bunch of kind of equal lows around here that you might want to, so these two here that you might want to take a second partial, but you could also leave a bit on for the H4 low, because given the H4 and H1 order flows are now in confluence, we assume that H4 low is going to fall for trend continuation. So that's how order flow kind of works down through the time frames as well, in confluence with your trading ranges and your major structure. And understanding what the order flow is at any given point within the time frame that you're looking at is key to both where you're going to enter, where your targets are going to go, where your partials are going to be, and how much you're going to leave in for external range liquidity in terms of trend continuation on the higher time frame. And really your way of identifying that order flow at any given time is by mapping out the major structure on those time frames. So your order flow follows your structure. Realistically, it's maybe not the textbook definition of how that would work and how ICT intends it, but from my mind and the way that I use it, it works fairly well within this scenario. So again, hopefully that makes sense. And that's going to wrap up the video tonight. There's a fair bit in that again, but hopefully covered a lot of the technical stuff around how you use these ranges and these structures together, and make a bit more sense. In the next video, we're going to have a look at some examples, some trade examples. I've specifically not put any entry models within this. This is all just a structural model, so this is very much how I build my narrative to then look for those entries. In the next video, we'll have a look at how we use this to frame that narrative, and then how the entries look alongside that, so it ties it all together to finish the series. But that's going to finish us up for this video. As always, thanks for listening. Any questions, add them in the comments, or ping me on social media or Discord if you're in the Discord. Hope you all have a good weekend. Until next time, stay safe. My tea's it. Gotta go.